Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by Grace Lay, co-manager of the Artemis Corporate Bond Fund, which features on our wealth shortlist of funds selected for their performance potential. So Grace, the Artemis Corporate Bond Fund invests in bonds issued by companies that are classed as investment grade, so high quality bonds as assessed by credit rating agencies. So given that opportunity set, what are you seeing in the market at the moment?
So I think there's a few ways you can look at the opportunity set within investment grade. The first is, as you mentioned, investment grade companies tend to be some of the highest quality companies in the world. And right now, you're getting paid some of the most attractive yields historically to be owning one of the safest asset classes in the world. So to put that into context, right now you can get paid a yield of around 5.5% to be owning some of the highest quality companies in the world. That compares to a yield of about 1.5% pre-COVID and the average of around 3% the preceding decade. So historically, we are looking at some very attractive yields for a safe asset class. Now, one of the questions you may have is, are we getting paid more because companies have become riskier? And that is not what we are seeing right now. Just to give you a bit of an idea, when companies can borrow very cheaply, let's say 1.5%, it's very easy to borrow that money for 1.5% and then invest it in things that may not necessarily add value. Now suddenly, when you're being asked to pay borrowings at 5.5%, companies are now becoming much more cautious around how they're going to be using that. So if anything, we have actually seen companies pare back on their borrowing or be much more mindful as to how they're doing it. So you're getting paid a yield for a company which is now investing in a much more cautious manner. The other aspect that we can look at whenever we look at the opportunity set within investment grade is investment grade companies, as you mentioned, are the highest quality companies in the world, which tend to be some of the largest companies in the world which have revenues in multiple currencies. When companies have revenues and operations in multiple currencies, they tend to issue bonds and debt in different currencies. Now, the thing that's so particular about bonds is no matter the currency the bond is issued in, they all carry the same risk. And so you would expect these bonds to all trade at similar valuations, but that's often not the case. So one thing that's very exciting as an active fund manager is to be able to look at all the quirks in the market, look at all those different currencies and see where to best be invested to have the best return for the client. So one of the things I really enjoy as an active manager is scouring the market, looking for all these inefficiencies, because let's remember, at the end of the day, as long as this company is still standing, pays its coupon, redeems the debt, you are getting paid for it. They have the same risk. And so we can look at bonds in various currencies, various tenors, and see where to best be invested for our client and add value that way as an active investor.
And so given the wide range of opportunities available to you, how is that influencing how you invest in the fund?
So right now, I like to look at companies where fundamentals are improving and where you're still getting paid a decent yield for it. So one of the sectors that I quite like at the moment are financials. If we cast our minds back to 2008 during the financial crisis, banks were heavily punished and yields went very high to reflect that. Now, since then, we have had regulators breathing down the banks' necks to try and de-risk their balance sheet, be much more cautious in their capital and what they hold. And so as a result of that, banks are now much safer than they were before, because regulators have been making sure that we don't have a repeat of the global financial crisis. At the same time, investors tend to have a short memory. So whenever something goes wrong, they look at what was the last thing that went really wrong. And people always think back to the global financial crisis. So whenever we do get a wobble in the market, financials tend to be hit. Now, I like to take the opposite view of that. Fundamentally, banks have improved. The quality of their loans have improved, and I don't think we run the same risk that we did during the global financial crisis. At the same time, you're getting paid very attractive yields for them. On top of that, we have to remember that yields are now higher. Banks actually benefit from rising yields because whenever they write a new loan, they actually make more money from that than they did before. So the combination of improving fundamentals as well as more attractive valuations makes me overweight the sector.
And reflecting on your career so far, what top investment tip have you learned over the course of that career that perhaps you wish you'd known at the start?
So I think one of the things as an investor, when you run a portfolio, is you have a lot of different positions in your fund. And often you will have these 1 or 2 positions, hopefully 0, but sometimes 1 to 2 positions that keep you up a bit more at night. And that is when you know that it's time to move on. You have to remember as a fund manager that you manage, let's say, 99 other positions. If you spend way too much time looking at these 1 or 2 positions, and that these 1 or 2 positions takes time away from the rest of the portfolio, you're not focusing on the whole. And I think one of the things that I've learned is to let go of one of these 1 or 2 positions to really focus on the whole of the fund.
And who would you say has had the biggest influence on your investment approach?
Well, that's quite an obvious and easy one. I've been working with Stephen Snowden for the whole of my investing career, which is nearly a decade now, and he has an influence of how I think about the markets. What I mean by that is, Steve is a very high conviction investor, but at the same time knows when to let go when something is going wrong, and that allows him to really focus on the fund, and that's something that I've picked up from him.
And outside of work, how do you switch off?
So I quite like diving. There is something about going in the ocean, staring down at the deep blue, being in a completely different environment that I just really enjoy. So I spend a lot of my time doing that, organising trips in faraway places, and if I'm not doing that, you'll probably be finding me playing an obscure video game somewhere.
Thank you for joining us.
Thank you.